Very good morning, friends. So, we are continuing with the trail of asset related Indies with you, and we've done a couple of Indies with you on asset based when we started the journey in terms of Indies 2, which talks on inventory. Then we went ahead on the Ind AS 10 and 37, which is, of course, not an asset related Indies. But then we came to Ind AS 16, that is again an asset related Indies, and now we're talking in terms of Ind AS 38. We drew a lot of reference to Ind AS 38 when we were talking in terms of Ind AS 16, where the focus was on the word tangible item. And we said that if it is intangible item, then we are covered under Ind AS 38. Now, the best part in terms of doing this Ind AS, immediately after Ind AS 16 is for the reason there are a lot of issues which are common in terms of Ind AS 16 and Ind AS 38. You'll see a lot of factors which are the guidance in this Ind AS is quite common. But when I am doing this particular index, unlikely what I've done in the previous standard, you would have noticed that every time I pick a standard, I just look at the name of the standard and then I start working on the name of the standard. So when it was PPE, I started, making analysis on what is a PPE. When it was inventory, I started looking into what is inventory. And even in terms of index 10 and 37, I did the same. But I think today I'm going to do something different with you. I'm not going to look at the definition of the intangible assets at the moment. Rather, I'm going to give you something different in nature. Let me first of all share my thought process. What is my agenda today? Because I think if you're able to understand this agenda, trust me, almost like 60-70% of the examination questions can be done with what we're going to do today. So, are you serious? That means we would be able to cover up the aspect in terms of 70% of the examination questions. Trust me, I'm not joking. I am serious. Now, if you look at India's 38, as the name is intangible assets, I think I'm going to, before I even look at the definition, though I think for a formality, let's have a look at the definition, though I am not interested in the definition at the moment because I'm not going to make any analysis on the definition at this stage. I'm going to come to the analysis at a later stage. But still, I think let's have a little look on the definition of intangible assets. And if you look at the definition of intangible assets, which is given in the standard, you can see a small, cute little definition in Index 38, which says intangible asset is an identifiable, non-monetary asset. You can see the word asset very clear, unlike Index 16, without physical substance. Though I think not making much analysis, but since we're looking at the definition, I think let's have a little look at this. So you can notice that there are certain key terms which are used in the definition, and I think to understand the definition, we need to understand the word identifiable. That's one. Non-monetary. That's another. Asset. That is three, and without physical substance. That is four. So I think, sir, for a change, we are going to look at a total of four questions. Is that so? Well, for the time being, yes. But you never know that I might increase it to five or might decrease it to three. That's, I think, what we're going to discuss later. So I think with this definition of the intangible assets, without any explanation being given to you, I am taking a little jump in terms of one of the relevant para, what tells me about the recognition of intangible assets. And if you look at the para number 18, I think there that is where the journey in terms of discussion should actually begin. If you actually ask me that if I, start explaining a person about intangible assets, I would tell him that you should, before reading anything, you should read the para number 18 of the standard. It says the recognition of an item as an intangible asset requires an entity to demonstrate that the item meets A and B, where A is the definition of an intangible asset, which we just saw, and the recognition criteria. That means the very first thing which I need to do is I need to meet the definition criteria. Apparently, there are four factors which seems to be present in the definition. And then he says we also need to meet a recognition criteria. But sir, isn't that quite similar to what we did in Ind AS 16 as well? That before we would recognize an intangible asset or a PPE in the balance sheet, you need to meet a recognition, the definition and the recognition criteria. True. So this is very apparently written in terms of Ind AS 38 that you need to meet both the definition and the recognition criteria. So I think since we've already seen the definition, I think let's have a look at the recognition criteria which is given in para number 21. And the para number 21 states an intangible asset shall be recognized if and only if it is A and B are met. And trust me, if you look at the para number 21 of this Ind AS and if you look at the para number 7 in terms of Ind AS 16, they are exactly the same. There is not even a single word difference in terms of the recognition criteria for Ind AS 16 as well as for Ind AS 38. You can look at the language in A and B. It says it is probable that expected future economic benefits will flow to the entity, and the cost of the asset can be measured reliably. So, which means we can see that the future economic benefits are probable, that's one, and the cost can be measured on a reliable basis, that's number two. Now, one thing which I've understood after the reading of this para number 18, looking at the definition in para 8 and looking at the recognition criteria in para number 21, though I'm not concerned with these paras at the moment, my mind certainly tells me that if you are talking of an intangible item, you need to meet the definition, which is apparently four conditions, and you need to meet the two conditions in the recognition. That means you've got a total of six conditions to meet. So anyway, I think 3 into 2 becomes 6, right? But that's just a chance again. So apparently what comes to the mind is that if an entity says that we are supposed to capitalize an expenditure incurred on an intangible item, you need to meet the four parameters of the definition and the two parameters of the recognition criteria. Then I can reflect it as an asset in the balance sheet. But let me say something more. I don't think so from an examination point of view or even from a practical life point of view. I would directly start looking at these six parameters. You heard me correct. When I said even from an examination point of view or even if you're looking at a practical life point of view, I really don't think so that a person would technically, start evaluating these six parameters because, the wonderful part in terms of Ind AS 38 is that the standard has given us a list of certain items which cannot be recognized as an asset in the balance sheet. So my mind tells me that why not we proceed something like this? That we first of all do one thing, we look at the expenditure incurred in the question and see, is it a part of that list which Ind AS 38 has given us that these cannot be recognized as an asset? And once you're able to zero down that, okay, these expenditures are within the list, then I think I can outrightly tell the examiner that this is a revenue expenditure. But in a situation where you say that the expenditure doesn't fall in that particular list, then I think I should apply these six conditions. What do you say? Doesn't that make logical sense? Yes, sir, it does. That means I am now giving you basically a two-step procedure. Oh my God, sir. Every time you are out with some kind of procedures, that means we are going to go to some complicated standards also. You're going to come up with some step-by-step procedure. I am very fascinated in terms of the step-by-step procedure which has been developed under Ind AS 115 on a revenue step model. I think the blend in terms of the FASB, which is the body which makes the US GAAPs called the Financial Accounting Standard Board, and the IASB, There is the International Accounting Standard Board, which makes the IFRS. Now they're working on a lot of latest standards, which is a joint project between them. So, like India's 115 was a joint project between them, and then even India's 116. That's IFRS 15 and 16, respectively. And the best part is, when you look at the US GAAP, it is largely rule based, and when you look at IFRS, it is largely principle based. And I think the blend works out very well. Like in India's 115, they've given a five-step model, which is more like a rule-based concept. And then, they've gone to the concept of introducing this principle-based concept within those steps as well. Anyway, I think that is something which we'll discuss when we come to India's 115. Now, so as I said, my mind is working on a simple two-step procedure in terms of India's 38. So the first thing is, and I think I'd like to show you the assignment as well, which is going to give you a feel. You can see that I have given the trail of the para numbers which we're going to look at for the definition and recognition criteria of the intangible assets. You can see the para number 8 talks on the definition, the para number 12, and then that is a little explanation on para number 8. Then you can see 18, which talks on meeting both definition and recognition, and 18. So you can see the trail with which I am teaching, and the trail with which the standards are given, the sequence is given, is going to be of course the same. And this is how we should actually approach. So that means, sir, now you're going to look at para number 48, 49, and then you're going to look at 54, 57, and then you're going to look at 63, 64, and then 69 and 71. 100% yes. And let me tell you, it's a 10-page assignment where you can see a couple of questions which I have picked up from the various sources. You can see a lot of questions, almost like you can see a total of 11 questions, which takes care of almost the 4 pages. So there are a total of, let me tell you how many questions are there in terms of totality. There are 29 questions, and out of 29 questions, you have got questions which is almost like 11 questions based on what I am going to teach you today. That works out at almost like 40%. Somebody who said 70%. There's a little more also which is connected to what we're going to discuss today, but I will not perhaps discuss that in detail today. But there is a trail which we're going to cover. So almost, I think if you add that, it would zero down to at least around a 60%. That means almost around 17, 18 questions you're going to find concentrated on this particular concept. Okay. So that was just to give you a good feel factor in terms of things. Now, coming back to the standard, I think let me first of all zero down on my two-step procedure. Don't worry, I'll give you the notes later. I always believe, you should first of all hear the concept and understand the concept very carefully. Once you've understood the concept at large, then I think that documentation, consolidates your learning process. And then, of course, when you do some practice on those particular areas, you will start becoming an expert on the area as well. So, let me begin the journey in terms of the two-step procedure of Ind AS 38, which I am developing. I said your first step in terms of Ind AS 38 is to see that is the expenditure falling in the list which is given in Ind AS 38. I'm going to give you the list. I'm yet to give you the list. So I'm going to see that is the expenditure falling in the list of paras which prohibits an capitalization. So if you say that the expenditure falls in the list of those para where Ind AS 38 prohibits the capitalization, then I think I will just quote that para and tell the examiner it's a revenue expenditure. And of course, you would attribute a reason also along with what the Ind AS says. And of course, the reason is also given in the Ind AS. It's not that we're going to create reasons on our own. And then if you see in the question that the expenditure doesn't fall in the list of paras, which I'm going to show you, then I think you should apply the parameters of meeting the definition and the recognition. So I think we'll come to the definition, recognition, 6 parameters later. Let's, I think, first look at the trail of the para numbers, which is the list which prohibits the capitalization. So I would also request, if it is possible, please do one thing. Why don't you remember, the para numbers which I'm going to show you? And I think if you can do that, I think it's going to be a little good deal. So why don't you even remember the para numbers which I'm about to show you? So let me begin the journey in terms of the first para, that is para number 48. So I'm looking in terms of para 48, where you can see at the very top it is given internally generated goodwill. For the time being, I think I'm just going to read these paras, and I'm not going to share the logic with you, because to share the logic, we need to understand those six parameters as well. Unless I know that these are the six parameters and what are those six parameters, I can't really explain you that which parameter fails in this, because it is one of those six conditions which will fail. And that is the reason that the standard is very explicitly mentioned that you cannot capitalize this kind of expenditure. Now, in terms of para number 48, it makes it very clear that internally generated goodwill shall not be recognized as an asset. I remember, and you would also very distinctly remember, what you've done in intermediate and partnership and in school, where everybody used to tell you that goodwill arising should not be recognized, and somewhere the other people would have also told you that this is due to the reason that AS 26 in IGAP and now Ind AS 38 prohibits the same. Now we'll come to the logic later that why an internally generated goodwill cannot be shown as an asset. So this is something like, a company has a reputation which is built over a period of time. You cannot show that as an asset in the balance sheet. So that's para number 48. Let's take it further. And I think let's go to para number 54. Now, as a part of the internally generated intangibles, the company could also be doing some R&D. That's what we call research and development. Now, when the company is doing R&D, that is research and development, the para number 54 talks of the research expenditure in a research phase, and the para number 57 talks of the expenditure which is done during a development phase. Now, if you read the para number 54, it makes it very clear that no intangible asset arising from research shall be recognized. It says expenditure on research shall be recognized as an expense when it is incurred, so it becomes a period cost. It is charged as an expense in the period in which it is incurred. So I think it makes it very clear that any kind of expenditure which is done on R&D and it is during a research phase is supposed to be treated as a revenue expenditure. Don't worry on the logic. I will come to the logics once again once I am done with all the six parameters of recognition and definition. Then I think we're going to document things at that stage. Similarly, as I said, if you're looking at research and development and you're looking in terms of a development phase, the para number 57 says that intangible assets arising from development shall be recognized if and only if the entity can demonstrate all the following. There are a total of six conditions. Well, I'm not interested in looking at these conditions at the moment. I'm only looking at that the expenditure during a development phase can be capitalized only if you meet six conditions. And the word all is very clear that you demonstrate all the following conditions. So that means that even if any one of the condition fails, then the development phase expenditure is going to be treated as revenue in nature. Absolutely. So does this also mean that the examination, we are going to make an evaluation of these conditions and we're going to look at whether these conditions are being met or not? Not really. I think the examiner has been quite kind. When it came to accounting standard 26 and even in terms of Ind AS 38, where he gives you the information whether these conditions are met or not. But I think for the time being, let's keep one thing in mind, that if the six conditions in a development phase are met, it is a capital expenditure. Rather, I would say it is eligible for capitalization. So what happens suddenly? You started using the word eligible for capitalization. I think I'm going to expand that concept later, but let's consider that even if you meet all these six conditions, it's not that I will certainly capitalize. I would say it is eligible for capitalization. So something like, when you do in borrowing cost, and you say that this expenditure is eligible and you don't say that it will be capitalized. So something similar needs to be evaluated in this case as well. So I think so far we have seen the trail in terms of para 48, which talks of internally generated goodwill. Then in terms of R&D, para number 54 research phase is revenue, and para number 57 in development phase, where depending upon the six conditions are met, it is eligible, and if not, it is revenue. Let's now go to the para number 63. Let's have a look in terms of the para number 63 and see that what is the status of some more internally generated intangibles. Mind you, when you were looking in terms of para 48, it was internally generated. When you were looking in terms of R&D 54, 57, again, you were looking in terms of internally generated, because through the R&D process, the company was internally trying to generate intangibles. And when you're looking in terms of para number 63, also the trail is talking in terms of internally generated again. It says internally generated brands, mastheads. I know what you're thinking. So what is mastheads? Don't worry, I'll explain. Publishing titles, customer list, and items which are similar in substance shall not be recognized as an intangible asset. Well, I think let me first explain what is a masthead. You would understand a publishing title. Like, for example, a magazine has got a title. A customer list is something, you've got data pertaining to your customer, the contact numbers, the email addresses, etc. And items which are similar in substance, something like a market share achieved by the company, that you have got, let's say, a 30% market share in the market. And internally generated brands also, that when we're looking at brands, we're looking at that, brand, the logo. Now, let's see what is mastheads. Now, mastheads, I would say, is, something like, okay, that also reminds me a little story, I guess. A real story. I think I should make a little walkthrough on that as well. I clearly remember that when I was a child, I used to see my grandfather, using a particular newspaper. Every time he used to read that newspaper, and it was a couple of years, I saw him for many years, reading that particular newspaper only. Though in between you were, I don't know whether you witnessed that or not, but in between there were many newspapers which came in. Right now, the prominent ones is like Hindustan Times, the Times of India. Then there was an Asian Age also, which, penetrated the market at that time. Now, there was a lot of inquisitiveness in me, and I asked my grandfather a day, on a particular day, why do you, read only this particular newspaper? He said, because of the mastheads. And that's how, I heard the term mastheads at the time. So, but what is mastheads? He told me one thing, that every magazine, every newspaper has an editorial board. Now, this editorial board is comprising of certain learned people, who would be, influencing what they write. And at that particular stage, I realized something very relevant and important, that the views expressed in a magazine, the views expressed in a newspaper is always the view of the composition of those people who comprise the editorial board. Now, the company, the newspaper, the magazine would always be proud in terms of, the editorial board it has got, because that would also decide the amount of revenue they can generate. So that is called a masthead. It is basically the composition of the editorial board. So that is, something which you develop over a period of time. As you would enhance your presence in the market, a lot of renowned people, knowledgeable people will get attached with you. But you could never, never show that as an asset in the balance sheet. Why? We'll come to that later. So, in this particular case, the internally generated brands, the methods, the composition of your editorial board, the titles, the publishing title, the customer list, and as we said, similar items like market share cannot be shown as an intangible asset. So, at that stage, I also realize something. I'm just diverting from the issue. But I think let me also tell you, it's very important in life in terms of what you read and whom do you hear. Because when you hear a particular person and when you read something, it is basically you are getting what that person thinks. So I personally believe, and I think it's a very vital thing in life. I'm digressing from the issue of the Ind AS for 2 minutes, but it's very important in terms of that you choose very carefully whom to hear for your learning and what do you read in terms of learning. Your learning will definitely get enhanced, and it all depends upon from what source do you hear and learn, from which source do you read and learn. So your source of reading and learning, your source of hearing and learning has to be a very important decision. So always make the decision on a very conscious manner. Okay, so that was para number 63, which again prohibits certain internally generated intangibles. And then I'm taking you to para number 69. And in terms of para number 69, we are again given a lot of couple of examples which are not to be shown in the balance sheet as an asset. If I look at the examples in A, B, C, D, in A it says the expenditure on startup activities, what you call the startup cost. Now, when you look at the startup cost, we can say the startup cost can be segregated basically into three kinds. One is called a pre-opening cost, and one is called a pre-operating cost. I said three, I think I should have said two. So your startup cost would be, expenditure incurred on a pre-opening. So say, for example, you are, opening, let's say, a new entity. So you've got some pre-opening expenditure. Or let's say it's a pre-operating cost. So that means you're starting a new operations or launching a new product line. So when you establish a new entity, you incur a pre-opening cost. And when you launch a new product, you incur the pre-operating cost. So these kind of startup costs cannot be capitalized. They will not be reflected in the books of accounts as an asset. And this is also including, any establishment cost in terms of any legal expenses, or in short, we can say preliminary expenses incurred. Number B, it says expenditure on training. When you do a lot of training activities to the employee, it would certainly enhance their skills, but at the same time, you cannot capitalize the expenditure. Don't worry, the reasons are yet to come. Then expenditure on advertisement and promotional activities. I remember as a student when I was in class 11th, 12th, and even in graduation, and even in terms of CA, I did a situation where the expenditure on advertisement was called a deferred revenue expenditure. And the deferred revenue expenditure used to be shown as an asset in the balance sheet. And then later, that was the Schedule 6 I'm talking of. And then, Accounting Standard 26 was made, and it was prohibited that advertisement expenditure cannot be shown as a deferred revenue expenditure. It is simply written off in the year in which it is incurred. And then it says expenditure on relocating or reorganizing a part or all of an entity. So, and I think let me also give you a little clarification in terms of para number 70 and the para number 71, and which makes it very clear that past expenses cannot be recognized as an asset. Once you have taken the expenditure to the profit and loss, once you've treated it as a revenue expenditure, it cannot be capitalized in the books of accounts at a later date. So I think now my mind is working on a very good platform, and I think let me share my thoughts back again with you in terms of Ind AS 38. So as I said earlier, I said that there is a two-step procedure, and I think now we have some more insight to discuss with you in terms of step number one. So we are now learning the concept of step one. Then I think I'm going to come to the concept in step number two. So as I said, The very first thing we need to do is we need to see that the expenditure incurred on the intangible item relates to para number 48, or it relates to para number 54 or 57 or 63 or 69. So do you think we'll remember these paras? Why not? If you make a little conscious effort, you can. And I think if you've got a little more involvement with the subject, you're going to be a little more passionate about the subject. Trust me, you will certainly get this. So just remember the easy para. It starts with 48, then goes to 54, then goes to 57, and then goes to 63, and then it goes to para number 69. So you need to see that the expenditure incurred on the intangible item relates to these paras. If yes, revenue. If no, then I think it's time to go to the next step and look at the definition and the recognition parameters. Do we document all what we have said so far? No. So, but why? Because I will also document the step number one with the logics also. That in terms of the para number 48 internally generated goodwill, what is the reason of not allowing a capitalization? Why does Ind AS 38 prohibit the same? And so on. So I think let's do one thing. Let's, I think, understand the larger concept, and then we'll do the documentation entirely in one go with you. So it's going to take some more time, I guess, but I think we're going to do this documentation, collectively in a single go. Now, start hearing me carefully. I am now looking at the definition and the recognition criteria. I think we already know the recognition in terms of future economic benefits being probable, and in terms of the fact that the cost can be measured on a reliable basis. Now, if you look at the definition, it says intangible asset is an identifiable, one, non-monetary, two, asset, three, without physical substance, that is four. Each word has got a meaning. Let's understand each and every term. That what do you mean by identifiable, non-monetary, asset, and a physical substance? Don't worry, notes would come later. So when you say it is identifiable, the word identifiable means that it is capable of being sold separately. It is capable of being rented separately, or it is capable of being exchanged separately. You need to basically prove the fact that this intangible item is capable of being sold, rented, or exchanged separately. Imagine if I were to say to someone that I'm going to sell my business to you, or let's say I tell somebody that I am going to actually sell you my goodwill but without my business. He would say, sir, you need to sell me your business in entirety. How would I get the benefit of your reputation, your goodwill, if you don't sell me your business? So can I sell my goodwill without selling my business? I cannot. So the goodwill which you have generated internally is not identifiable in nature. Oh, that is the reason that para number 48 prohibits you from capitalizing that goodwill in the balance sheet, because it fails one of the parameters of the definition itself. And unless you meet all the definition parameters and all the recognition parameters, you cannot show the item as an asset in the balance sheet. But it is not necessary that only, the goodwill will only fail the identifiability test. It could also fail other parameters as well. I think I'll come to that later once I do the documentation. But I think one of the main reasons which even the Ind AS makes it very clear, in para number 49, that as far as a goodwill is concerned, it is not identifiable, because you cannot sell goodwill, rent or exchange goodwill separately. You need to do it along with the business itself. So I think we've understood what is identifiable. Next, it says it is non-monetary. Now we all know that assets or liabilities are either monetary or non-monetary in nature. Now, when I say that the asset is supposed to be a monetary or non-monetary, I think we need to go back and see what you've learned in AS11 in IGAP. The same concept applies to Ind AS as well. So when I say the item is monetary in nature, then we are saying that the amount to be received is fixed or it is determinable. But when we say that the amount to be received is not fixed, I'm talking in terms of asset. But when I say a liability, the amount to be paid is fixed. So I would say a monetary item means that in terms of asset, the amount to be received is fixed or determinable. And in terms of liability, the amount to be paid is going to be determinable or fixed. So when the amount to be received is not fixed, the amount to be paid is not fixed, it becomes non-monetary in nature. Now, the amount of economic benefits which you are going to get from an intangible asset is not something fixed in nature. When you look at items like inventory, when you look at items like PPE, when you look at items like intangible assets, these are all items from whom the economic benefit is not fixed. It is going to vary. So when you're looking at the fact that the intangible item is to be shown as an asset, you need to basically prove that the future economic benefits will vary. And then it says asset. And I don't think so. I need to overemphasize the word asset because you've seen it in terms of Ind AS too, that when you see the word asset, it has got twofold feature in terms of the definition. One is that you are looking at the fact that you should have a control, and the other is you should be getting a future economic benefits. So that means, in terms of asset, we need to fulfill the two parameters. One is that future economic benefits are probable in nature, and you should be having a control by way of legal ownership or by way of restricting others from use. Yes. So that effectively makes it five, actually. Because when you're going to look at identifiable, it's one. When you're going to look at non-monetary, it's one. But in asset, we've got two conditions. One is FEB, the future economic benefits, and the other is control. And then the last word says without physical substance. Now, when I say without physical substance, well, I am not saying that it will always be without a physical substance. There can be a tangible element related to an intangible asset. But the value of the tangible element will be generally negligible in nature. For example, if you look at a software which is, loaded in a CD, the value of the CD is practically immaterial as compared to the value of the software. So generally, you can say that the item will be purely intangible, but if it has got a physical substance, the value of the tangible element is going to be material, immaterial, negligible in nature. So now we can zero down on something. I think I'm interested in doing some analysis with you. So let's do one thing. I think, begin with the concept of the definition and merge the recognition criteria along with this. So I am saying that when I am looking in terms of Ind AS 38, one thing we have seen very carefully from para number 18, and that is that you need to meet the definition and the recognition criteria. So for an intangible asset to be shown in the balance sheet, we said you need to meet the definition. These are not the notes. I'm just still developing a thought process. And this is, we also said we need to meet the recognition criteria as well. This is what we read in terms of para number 18, that you need to meet the definition and the recognition criteria put together. Now, when I looked at the definition, I could see that in terms of definition, one of the conditions is identifiable, which we said that it is capable of being sold, rented, or exchanged on a separate basis. And another thing, we said that it is non-monetary. And when I said it is non-monetary, I basically made a reference to non-monetary, that the future economic benefits should vary. And then we said another condition in terms of the Definition is that it is supposed to be an asset. And when I was looking in terms of asset, we said that the future economic benefits are probable. That's one feature of the asset. And we said that in this particular case, you should have a control in terms of legal ownership or the right to restrict others from the use of the asset. And we said another parameter also, and that is generally it is without any physical substance. So it is without any physical substance. So this is how we segregated the definition in terms of the four, or you can say the five conditions, because asset has got two parameters. Now, as we've already seen in terms of Ind AS 16, and I think I connect you back in terms of the recognition criteria. The recognition criteria means that the future economic benefits are probable. The future economic benefits are probable, and we can measure the cost on a reliable basis. The cost can be measured on a reliable basis. If I start looking into these things, and I think if I combine my concept in terms of the definition and recognition, now hear me very carefully. I think I'm going to zero down on a total of 5 questions which I need to put across. So instead of using the word probable, we can also use the word that future economic benefits would arise. Now, look at this very carefully. I am going to ask myself a total of 5 questions before I can capitalize this intangible item as a balance sheet asset. The first question which I'm going to ask myself is it identifiable? The second question I'm going to ask myself is that will the future economic benefits arise? Will the future economic benefits vary? And will the future economic benefits are probable? There are three different things. Economic benefits will come, but there has to be a good probability that they will come. This is like two different things. You will get economic benefits is one thing, but the probability of getting these economic benefits is more than 50% is another thing. And these economic benefits will vary. So when you look at the second question, you need to basically zero down on three concepts: that future economic benefits will come, they will be probable that they will come, and they will vary in nature. Then number three, I'm going to put across a question to myself: that do we control this intangible item? Do I have a legal ownership, or do I have the right to restrict others from the use of this particular asset? And then number four, I'm going to put across another question: is it generally without a physical substance? And then finally, we will look at the fifth one: that can I measure the cost on a reliable basis? Trust me, if you're able to meet these 5 conditions, you can see the movement of the hand as well, that 5 conditions that would make it as an asset to be recognized in the balance sheet. Wow. So I think I have created my thought process to you. And I think again, I've taken almost like 45 minutes to do that, or maybe almost like 50 minutes to do that. And you already know that I always have a habit of spending almost around 40-45 minutes on an average understanding the approach which is required to understand the standard. Unless your thought process is very clear in terms of an attacking strategy, we can't really learn the nitty-gritties related to the standard. So, by the way, I have already explained you the term what is an intangible asset. I think now I need to zero down and consolidate my entire concept and then document the same and then apply this to certain practical illustrations with you. So I have now decided, as we earlier decided as well, that there is a two-step procedure in terms of recognizing the intangible item in the balance sheet as an asset. Mind each and every word of what I'm saying. I'm being very careful and choosy in terms of the terminology I am saying. So when you say that an intangible item is to be reflected as an asset in the balance sheet, there is a two-step procedure. Step number one. Does the expenditure fall in the list of items, the list of expenditures given in Ind AS 38, which prohibits the capitalization? So you need to zero down, is it a part of para 48, 54, 57, and then 63 or 69? The answer is a yes. I think the decision is taken that it's revenue expenditure. And if the answer is a no, then you go to the step number two and look at the satisfaction of five parameters. The first is it identifiable? Is it capable of being sold, exchanged, or rented separately? And generally, if the intangible item arises out of contractual or legal rights, we will always presume that it is identifiable in nature. Number two, would the future economic benefits arise? Is it probable that they will arise and will they vary? Then you go to the third question. Do you control this intangible item in terms of a legal ownership or the right to restrict others from the use of the asset? Then number four, is it generally without any physical substance? Even if it has got a tangible element, the value of the tangible element is immaterial or negligible. And number five, you can measure the cost of the intangible item. If all the five parameters are met, it can be shown as an asset in the balance sheet, and if not, then it is a revenue expenditure. So, but you also said that after elaborating all these five parameters, you're also going to give us the logic in terms of why does the para number 48, 54, etc., prohibits the capitalization of the expenditure. Of course, I think now we are in a comfortable position to elaborate that concept also to you. If you think in terms of goodwill, I think I've already given you the logic that internally generated goodwill is not identifiable. It is not capable of being sold separately. And even internally generated goodwill is not also, measured. You cannot measure it. It fails the condition number one, identifiable, and the condition number five, that the cost can be measured on a reliable basis. And even it fails, the third condition, the second condition in terms of future economic benefits also to quite an extent. If you look at the para number 54, that is a research phase. The research phase is a phase when you are trying to actually still find something. In that case, future economic benefits would never be probable. Unless you convert your research finding into a development phase, the future economic benefit factor would always be missing. Then we looked at para number 57. And if you look at the conditions in terms of the para number 57, trust me, you will see all those five conditions indirectly there in para number 57. Though I'll be coming to those conditions later, but let me tell you point blank, you will see a lot of these conditions are there in terms of para number 57, a direct indirect mention, especially in terms of future economic benefits and especially in terms of cost. Out of those six conditions, those two conditions are very apparently out there. Then para number 63, when you're looking in terms of internally generated brands, customer list, etc., they would fail the fact that you cannot measure the cost again. Companies cannot identify the amount incurred in developing those internally generated brands or customer list, etc. You can never identify how much money has been spent, because you would incur expenditure in developing the business as a whole. And as a part of developing the entire business, you would also develop your brands and you would also develop your titles and customer lists. So it's being developed over a period of time. And you can never measure the cost which is incurred in creating these kind of assets. So it fails the point number five, the condition number five. And then if I look at in terms of para number 69, not every expenditure would have common logic. For example, if you look at training, it would fail the concept of condition number three, control. We never control the employees. Agreed. You train them, their skills will get enhanced. The company would get future economic benefits in terms of their enhanced skills. But you can never control employees. They can always leave the organization. So, but if you get a bond signed with them, well, the bond will also have an exit clause. They will always pay you a penalty and move out of the contract. You cannot bind an employee. You can never control the employee. And that is the reason human resource, which is one of the most vital elements for a company, is never shown as an intangible assets in the balance sheet. Otherwise, companies have got so good level of human capital, the staff strength which they have, and the level of knowledge and the knowledge pool of employees they would have, that would create a very good intangible in the balance sheet. But it would always fail the parameter of control. If you look at, for example, the advertisement expenditure, I think you can never prove that future economic benefits are probable. Advertisement would not ensure that sales will always pick up. It is an expectation, that when you advertise, there is an expectation that economic benefits, more sales will happen. But there is no surety. You cannot say that it is probable that, economic benefits will come. So different expenditures which have been prohibited, fail any of these conditions. And one logical question would also come to your mind. So if any of these parameters is failing, then the standard would not have given the negative list. We could have applied our minds directly and we could have, zeroed down whether it can be capitalized or not. Agreed. But the standard always gives you a guidance, and where we know that there is a guidance which can be given, we know for sure that this kind of expenditures should not be capitalized. I think it is very important to give that guidance. Otherwise, we are all manipulative natures in life. We've all got manipulative natures in life. And trust me, if the presence of para number 48, 54, 57, 63, 69 would not have been there, I'm sorry, but I think we all have that manipulative intentions that we could have landed up treating revenue expenditure as capital by hook or crook. We could have proved the parameters of these five conditions as well. So I think the standard went on a very safe guidance. They said, let's tell the, entire practicing, the entire industry at large that, boss, please don't try to manipulate these cases. In these cases, the concept is absolutely crystal clear in the mind that you cannot capitalize expenditures on these particular items. So I think, therefore, the presence of the specific paragraph, though one could always logically apply and decide whether it is going to be capitalized or not. I think now it's time to make some documentation with you. I think let's now document all these inputs to you in the form of a two-step procedure. And trust me, with this two-step procedure, as I showed you, one can easily attack those 11 questions easily. Okay, let's do one thing. After doing the documentation, I think we'll run through a few selected questions with you where, we will just read the inputs and we will be able to get the answer immediately. Trust me, the moment you know the two-step procedure, you're going to do the question in just few seconds. So I think let me now formally begin with the concept of the two-step procedure. So we're looking at the two-step procedure in terms of deciding it's not in the mood to get I think stuck up maybe sometimes. Okay, finally. So it's a two-step procedure. I think it's got stuck up on the concept. So there is a two-step procedure which we are going to use in terms of Ind AS 38 to decide whether item is capital or the item is revenue in nature. So let's begin the journey in terms of step number one. And in terms of step number one, we will see, is the expenditure related to items mentioned in items mentioned in para number 48, 54, 57, 63, or 69. Don't worry, we'll also document what is contained in these para. So we'll ask ourselves, is the expenditure related to items mentioned in these paras? So the answer would be either a yes or the answer would be a no. So if the answer is supposed to be a yes, then I think we have decided it is a revenue expenditure. Then we have decided it is a revenue expenditure. And if the answer is a no, we're going to go to step number 2. So I think before we go to the step number 2, I think let's make a chart indicating what these paragraphs are telling us. So a little guidance on these paras. And as I said, if you can remember these paras, I think that's going to be wonderful. So para number 48 and then para number 54 and then para number 57 and then para number 63 and then para number 69. So we'll make a list of the expenditures and the logics of why these expenditures would not be capitalized. So para number 48 gives us the concept of internally generated goodwill. It talks about internally generated goodwill, and in terms of internally generated goodwill, if I give you the logic as well, it is not identifiable. It fails the identifiability test. So it is not identifiable. If you look at in terms of para number 54, we are looking in terms of the research phase. And in terms of the research phase, we can say that this is revenue. Reason: future economic benefits will not be probable in nature. We would never be able to prove during a research phase that future economic benefits would certainly arise. 50% plus chance. Then we're looking in terms of the development phase. And in terms of the development phase of expenditure, this is subjective. It all depends upon the 6 conditions. If the 6 conditions are met or the 6 conditions are not met. So in a situation where the 6 conditions are met, then I would not say it is capitalized. I would rather say that it is eligible to be capitalized. Now, why I'm saying it is eligible to be capitalized, that's what we're going to see later, not today. Because I'm going to discuss the concept of R&D in a detail later on. And if they are not met, then I think it is clear that it is revenue in nature. And if you look at the logic that why it is revenue in nature, once we look at those 6 conditions, you would understand that there could be different logics of why it is not being capitalized. And similarly, in terms of para number 63, we could see in terms of internally generated brands, in terms of internally generated brands, in terms of methods, in terms of customer list, in terms of customer list, in terms of publishing titles, in terms of publishing titles and other items. So I think let's put one more, that is, let's say a market share, etc. And the logic in terms of why these expenditures would not be capitalized, and this is the cost cannot be measured reliably. The cost cannot be measured reliably. So we cannot measure the cost reliably. The cost cannot be measured reliably. And then finally, we also had a few list of items in para number 69. And in terms of para number 69, we are looking at, let's say, training. We said there will not be any control. We said advertisement. We said there may not be future economic benefits. We said there could be a startup cost. The startup cost would include something which we said preliminary expenses. You pay some legal charges, secretarial expense. There could be pre-opening cost and there could be pre-operating cost. So pre-opening and pre-operating cost and the cost of relocation. So let's say you relocate your factory from one place to another. So cost of relocation. So all this is something which will be treated as revenue in nature. So I think we've got the list of all the items in step number one, that if the expenditure pertains to any of these items, then it is revenue in nature. Now let's go to the step number two. Once you're able to identify that the expenditure is not pertaining to any of these paragraphs, then what we need to do, we need to look at the five parameters. We need to see whether the five parameters are met or not. So we need to see that the five parameters are met or not. So let's make a list of all those five parameters as well. So we can say, first of all, if they are met, the answer is a yes or the answer is a no. If the answer is no, that the parameters are not met, then it is certainly revenue expenditure. You cannot show it as an asset in the balance sheet. And if the answer is yes, then it is going to be capitalized in the balance sheet. And then the question arises, how would you measure it? And trust me, the measurement principles are quite similar to what you've done in Ind AS 16. Now let's take it further and let's see what are those five parameters as well. Let's have a look at what are those five parameters which needs to be evaluated. So we'll divide this in five parts. So there are a total of five parameters which needs to be evaluated in this particular step. So the first parameter is in terms of identifiable. We need to see that it is identifiable. Identifiable, as we said, it is capable. It is capable of being sold, exchanged. It is capable of being sold, exchanged, or rented separately. Or rented separately. So if we can separately sell it, exchange it, or rent it, then it meets the identifiability test. The next is, we said we need to look at the concept of future economic benefits, and there are three parts to the concept of future economic benefits. You need to first of all prove that they will arise. The second, you need to prove that it is probable that they will arise. And you need to prove that they will vary as well. The economic benefits will vary, will prove it that it's non-monetary in nature. Then the third parameter is in terms of control, and in terms of control, you would either prove that there is a legal ownership. You would either prove that there is a legal ownership, or you would either prove that there is a right to restrict others. There is a right to restrict others from use. There is a right to restrict others from use. So one of the two parameters need to be proved. Either we've got a legal ownership or we can restrict others from the use of the intangible item. And the next parameter is generally without physical substance. The next parameter is in terms of generally without physical substance. It is generally without any physical substance. As we said, even if there is a tangible element, then the tangible element is not supposed to be material in value. And finally, we also need to prove that the cost can be measured reliably. The cost can be measured reliably. So I think with this two-step procedure, I think we should be fundamentally absolutely clear regarding the approach in terms of Ind AS 38, that when you confront an expenditure and you need to decide its revenue or capital, go to the list of paras. If it doesn't fall, look at these five parameters. If it meets, its capital. If it fails, it's revenue in nature. And I think now, unless we do some questions with you on this area, I think we will not get the full level of confidence. So let's do one thing now. Let's make a little walkthrough on certain questions with you so that we can get a little feel in terms of the concept. So I think we can now easily look at the question, and trust me, the moment you go to look at the question, your mind should start working on whether it is going to be capitalized or not. The trail of the para numbers is also given for your clarity of thought. Sun Limited has an expertise in consulting business. In the past year, the company gained a market share. Market share takes you to the concept of para number 63, and the logic in terms of why it is not going to be shown as an asset is given in para number 64, which tells you that you cannot measure the cost. You can never attribute how much money is being spent in creating this intangible. It says the company gained a market share and considers it to recognize as an intangible asset. Is the action justified? No, because it falls under para number 63. Let's have a look further. It says in question number 2, the company XYZ has provided training to its staff. Training. The word training immediately triggers your thought on the para number 69. And to be specific, it is para number 69B. And if it is based on 69B, you cannot capitalize. It says, can the company recognize? I think if the fundamentals are clear, trust me, the moment you read the question, you won't have to read the entire question, but don't do that. Read the question properly. Let's have a look at the question number 3. It says a software company is developing a new software for the telecom industry. It employs 100 engineers trained in that discipline who are engaged in the development of software. Accelerated feels it has got an excellent HR policy and does not expect any of the employees to leave in the near future. It wants to recognize these set of engineers as a human resource in the form of intangible. Now, if you do training, however confident the HR policy might be, how much confident the company might be in terms of generating economic benefits, control is the missing factor. Again, 69B. Let's have a look at question number 4. I believe, I trust that with this kind of understanding, your thought processes should be on a cloud 9. Now, if you look at the question number 4, it says Pluto Limited intends to open a new retail store in a new location in the next few weeks. Pluto spent a substantial sum on a series of television advertisements to promote this new store. It says that Pluto has spent a substantial sum on the series of television advertisements. And I think the word advertisement again triggers my thoughts on the para number 69, in specific 69C. And then he tells you what is the money paid, blah, blah, blah. I think I don't want to even read that. Can you imagine this kind of questions coming in the mock test papers and the RTP, and you could see those questions coming in the exams as well? Oh my God, isn't that superb? Have a look at the question number 5. It says X garment spends towards promotions. Oh my God, I think I don't want to do few questions with you because I think they are so easy. Let's take the trail further. Let's have a little different question. Question number 6. It says an entity is regularly placing advertisements in newspapers, again advertisement, and includes a reply slip. But this time it is not an advertisement, and includes a reply slip that informs the individual replying to the advertisement that entity may pass on the details to other seller of similar products unless he ticks the box in the advertisement. So you take information about the individual and you go to sell that information. Over a period of time, the entity has assembled a list of customer names and addresses. Customer list, para number 63. The list is provided to other entities for a fee. That means you can generate economic benefits. The entity would like to recognize this as an asset because expected benefits are derived. Now, in this kind of question, you need to make the examiner clear also that why you would not show it as an asset, because the cost cannot be measured reliably. You can never identify the money which has been spent in terms of creating this customer list. Okay, now question number 7, I guess, has got some inputs where we're going to, look at a little more inputs in terms of para 65. So I'm not taking 7 and 8 because they need a little more understanding on the development phase, as I said, which we need to understand. But I think we can do a question number 9th, I guess. Few questions, of course, we can leave that to you. Let's have a look at question 9th and 10th. I think this is again a pretty easy one, and it says X pharmaceutical seeks your opinion in respect of the following accounting transaction. You acquired a 4-year license. Trust me, generally, when you look at an asset which is acquired, it will always meet the 5 conditions in terms of the definition and recognition. So, because when you acquire an asset, now imagine if the company is going to acquire a license, number one, if I ask myself, is it identifiable? Yes, you have acquired it separately. So I'm sure you can sell it separately as well. Licenses can be sold to another entities as well. So it would be identifiable. And if you have paid a certain amount of money in order to acquire that license, which would give you a right to do something, like in this case, to manufacture a drug, so that means future economic benefits should be probable and arise and vary as well. And I think control stems out of the legal ownership directly. And license is certainly intangible without any physical substance. And you know that what you paid, that is 100 lakhs. So cost would be easily measurable. So for all those assets which are acquired, generally, you could easily attribute that all 5 parameters will get met. So this point number 1 relates to a situation where the company is, where the expenditure is not falling in those list of para. So we're looking at the 5 parameters. Then he says in point number 2, we also purchased another company at the start of the year, and as a part of the acquisition, we acquired their brand. It's not an internally generated brand. It is during the course of acquiring another company, you acquire their brand. It's internally generated for them. But for me, it is an acquired asset. So this will be capitalized. Then point number 3 talks in terms of advertisement. And when it talks in terms of advertisements, outrightly we know para number 69C prohibits. And then in terms of the point number 4 and the point number 5, it needs a little insight again on the para number 57, which I've not elaborated so far. So let me not get into that para number 57 at this stage. Let's have a run through on, let's say, another question with you. It says X purchased a franchise from a restaurant. It purchased a franchise from a restaurant and it has got a life of 10 years. And in addition, the franchise agreement mentions that the franchisee would also pay a royalty based as a percentage of sale. As I said, the moment you purchase, you acquire an intangible, You would generally fulfill all the parameters. And I think even in this case, if you try to evaluate whether those conditions will be met or not, you would certainly zero down that it is identifiable for sure. The future economic benefits will arise, probable, and will vary. And there will be a control because of the legal ownership, because you've got rights, so there would be a contract for the same, which will give you exclusive rights. And you can measure the cost, and since it's a franchisee, there is an agreement on a piece of paper, so it is an intangible item for sure. And I think similarly you can have a look at the question number 11, where it says you acquired a telecom license. And when you acquire a telecom license, the moment you see it's acquired, then I think the five parameters will easily flow in nature. So I think what is the model of the story, what we have learned on the partner one of this index is that when you're looking in terms of the intangible assets, you need to get on to a two-step procedure which I have developed with you. You would first of all look into the question, as we've just now seen the trail of all the questions, that you need to first of all see that the expenditure mentioned in the case study is pertaining to either para 48, 54, 57, 63, and 69. And I think my saying that para numbers so often would also make you think on those para numbers as well. And once you're able to zero down on the fact that yes, it relates to those particular items, it is revenue. Otherwise, you go to the five parameters in step number 2. And generally, when the asset is acquired, you would generally prove all the five parameters as well. And if you meet them, it is capitalized. And if you fail them, then it is treated as a revenue expenditure. So once you've decided that yes, it is recognized as an asset in the balance sheet, the next issue is in terms of deciding the measurement. The initial measurement and the subsequent measurements, whose principles are quite largely similar to what you've done in Ind AS 16. And once you're done with the aspects of measurement, the next agenda is in terms of amortization. Just like a property, plant, equipment is supposed to be depreciated, this is going to be treated as amortization. So the two agendas which are now left in the standard is in terms of measurements and in terms of amortization. And of course, we need to have a little more insight on the concept of development expenditure. We need to look at those 6 conditions also in a little more detail. So I think we're done with the first part with you. So we're going to meet you with the second part in the next session. So I hope we've understood the concept at a good and a larger level. So time to take goodbye from you. See you and thank you.